Welcome to Value Vest Daily, where we analyze the best value and momentum investment opportunities. The AI boom is here. It's happening right now. And the biggest question on every investor's mind is, how do I get a piece of the action without getting totally wiped out? Well, today, we're exploring a path that aims for a much smoother ride. We're going to break down two key AI-focused exchange-traded funds, CHAT and AIQ. I mean, this is the big dilemma, right? You see the incredible, mind-blowing potential of AI, but trying to pick the individual winning stocks, man, that can feel like a wild roller coaster. One bad report, one market shift, and you get some serious whiplash. So how in the world do you capture all that incredible upside potential without the intense, stomach-churning volatility? And this right here is the solution we're digging into today: exchange-traded funds, or ETFs. The easiest way to think about them is like a basket. Instead of buying one single stock, you're buying a basket that holds dozens of different companies all in one go. And that diversification, that's what helps cushion the blows, offering a much more stable way to invest in the AI revolution.
So let's get to the main event. We are putting two of the biggest names in AI ETFs head-to-head. Now, they both are targeting the exact same massive trend, but as you're about to see, they go about it in two fundamentally different ways.
This slide really frames the core difference perfectly. Think of CHAT as the expert's pick. You've got a team of managers actively choosing what they believe are the absolute best of the best generative AI players. It's a really focused, high-conviction bet. AIQ, on the other hand, is what we're calling the ecosystem play. It just passively follows a broad index, which gives you a piece of the entire landscape: hardware, software, big data, the whole shebang. Let's zoom in on CHT for a second. It's the newer kid on the block, right? It launched in 2023, smack in the middle of the whole generative AI craze. Its strategy is laser-focused on the companies that are really driving this ChatGPT era. And here's the key. Because it's actively managed, the fund managers can pivot on a dime as this space evolves, which it does at lightning speed. And here's its counterpart, AIQ. Now, this one's been around since 2018, so it has a much longer track record. As a passive fund, it just follows a set of rules, tracking a specific index of about 90 companies. This gives it much broader, more diversified exposure across the entire AI sector, not just those flashy generative AI stars. So here's the crucial question. When you buy one of these ETFs, what are you actually buying? What's under the hood? This next part is where we peel back the curtain and look at the top companies that really make these funds tick. This table tells such a fascinating story about their different philosophies. Chat, on that top row, look at that. It's a who's who of US tech giants that are powering generative AI. You've got NVIDIA, Alphabet, Microsoft. It is a very concentrated bet on the current leaders. Now, look at AIQ. It's so much more global and diverse. You've got China's Alibaba, EV leader Tesla, Korea's Samsung. It just goes to show a much broader interpretation of what an AI company even is. All right, strategy is one thing, but performance, well, that's what we're all here for, right? So let's dig into the hard data, the costs, the growth, and just how big these two funds really are. Okay, lots of important numbers here, so let's break it down. First, that expense ratio. That's basically the annual fee you pay. AIQ is a little bit cheaper, which is pretty typical for a passive fund. Next, AUM, or assets under management, shows you the fund's total size. You can see AIQ is a much larger, more established fund. But the growth numbers, that's where the story gets really interesting. CHAT had a monster first year, up over 47%. AIQ, with its longer history, shows a steadier but still very impressive 16.4% average annual growth over the last 5 years. That's its CAGR, or compound annual growth rate. Now, looking forward, the source material projects that CHAT's super-focused strategy could lead to even higher annual growth, somewhere around 32.5%. That means it could potentially outperform both the broader AI market and the more diversified AIQ. Of course, you gotta remember, these are just projections, but they really highlight the potential reward that could come with CHAT's more aggressive risk. Okay, let's shift gears from the fundamentals over to the technicals. This is all about market timing, risk, and what the charts were suggesting at the time the source material was put together. Now, this is absolutely crucial for understanding risk. Beta, it basically measures how much an investment moves compared to the overall market. A beta of 1.50 means CHAT is expected to be 50% more volatile, more jumpy than the market. So on good days, it could go way up, but on bad days, it could fall much harder. AIQ, with that lower beta, suggests a comparatively smoother journey. So this brings us to the big million-dollar question from the source. With all this data crunched, did the technicals suggest it was a good time to jump in? And the verdict from the source was a pretty clear yes. At the time, key indicators like the RSI, which measures momentum, were suggesting both ETFs were oversold. In simple terms, they might have been a bit undervalued, meaning a rebound was likely. Both had pulled back, but were holding strong above key long-term price levels, creating a classic buy-the-dip opportunity. All right, let's make these percentages real. What could this growth actually look like in your portfolio? And just as important, what are the risks we absolutely have to keep front and center? This number right here shows the incredible power of compounding. The source ran a projection. A $10,000 investment, growing at an average of 30% a year, could become over $37,000 in just 5 years. Now, this is just a hypothetical scenario, but it vividly illustrates the kind of wealth creation that could be at stake here. Of course, we have to hit pause for a very crucial disclaimer. This explainer is based on our source material and it's for educational purposes only. It is not financial advice, and it is so important to remember that past growth and projected growth never ever guarantees future results. And here are those risks. That high beta we talked about, it means bigger losses in a down market. Both of these funds are heavily concentrated in the tech sector, which is a risk if tech as a whole hits a rough patch. There's also the danger that all this AI hype has pushed stock prices to just unsustainable levels. And finally, the big tech companies that dominate these funds are constantly under the microscope of government regulators.
So after all that, it really all comes down to this. The source positions the choice pretty clearly. If you're an aggressive investor and you want a concentrated bet specifically on the leaders of the generative AI wave, CHAT is framed as your vehicle. But if you prefer a more balanced, diversified, and lower-cost entry point into the entire world of AI, then AIQ is presented as the better fit.
The source material ends on this really powerful, optimistic note. It frames the opportunity not as some chaotic gold rush, but as a potential highway for building wealth, as long as you choose the right vehicle for your journey. And that leaves us with a final question, which is really the core of this whole decision. For the AI revolution, do you bet on the expert pilot, that's chat, believing they can navigate to the greatest heights? Or do you invest in the entire fleet, that's AIQ, confident that the rising tide of AI is going to lift all ships? It's a fascinating choice, and there's really no single right answer. We would love to hear what you think down in the comments. Are you on Team Chat or Team AIQ? Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk, high-reward opportunities. Thanks for tuning in.